Welcome back to Accounting with Vernon. As I spoke to you on my last video for Unit 2, the Edexcel Pearson's specification, we had a good look at the unit, that was Unit 2, Corporate and Management Accounting. We saw how the paper is going to be made for you and what the examiner is going to look at and how you have to answer the questions. Remember, Section A and Section B, we have looked at that. And from today onwards, I'm going to give you the theory, the calculations, and the skills that you need to do well for your exam. So remember, this channel is for your betterment, for your information, and for you to do well in the exam. So please don't forget to subscribe my channel, share it with others, so that will be a good motivation for me. Okay, right. So today, the first lesson in the syllabus or in the Unit 2 content was limited companies. As I told you the other day, limited companies, we will be looking at three main areas. For limited companies, we will be looking at three main areas. What were the three main areas I mentioned? I said we have to prepare the financial statements, right? We'll have to prepare the financial statements for limited companies. Then we'll have issue of shares. Okay, we'll have to look at issue of shares. And then there was mergers. So we had three areas: the financial statements, the issue of shares, and the mergers. I told you I will do the financial statement and the issue of shares together, and then I'll do the mergers separately, right? Today, I'm going to take you through the first part of a company, the capital structure. So before we go to final accounts, it's very good to have a very nice flow of lessons. So we are first going to start by looking at how is the capital structure of a company. Okay, we are going to look at how is the capital structure of a company made up of. Then we'll look at what types of shares we have, or how is the share capital made up of. Okay, then I will take you through the capital and the revenue reserves, because we need this capital and revenue reserves for the next part of our syllabus requirements, especially when we speak about the bonus and issue of shares, as well as the redemption of shares. Okay, so today my lesson will be the capital structure, types of share capital, capital reserves and revenue reserves, and I will touch on the initial public offering, the application allotment stage, so that we can start doing calculations from our next lesson. Right. Now, when you see the word capital structure of a company, should come into your mind, how will a company design, or how will the company structure of a company be made of? How will the capital structure be made of? Right. So mainly we look at equity. Now, what is equity? Equity is shares. Equity is shares. A company can issue shares, as we are going to learn. A company can issue ordinary shares. A company can issue preference shares. So equity is made up of shares. As you can see here, equity capital is shares. So we are going to look at shares. Okay. There can be in the capital structure, debt capital as well. Debt capital, or we call loan capital. Okay. So debt capital can be made up of loans and debentures. There can be loans and debentures. We won't be looking at much about loans and debentures, right? I'm just trying to give you how a capital structure is made up of. And then the third one that a capital structure can have is the reserves. Okay. There can be capital reserves, there can be revenue reserves. Okay. So now for your understanding, how is a capital structure made up of a company? A mix of funding sources. It's going to be a mix of funding sources of a company. It's not only shares. It can be shares, can be loans, can be debentures, can be capital reserves, can be revenue reserves. So it's a mixture of these sort of funding sources. Okay, that's how the capital structure of a company is made up of. You can see now we are starting from the tiniest part. Share capital is the major part of this unit requirement, which we will be taking you there how the time permits. Okay, the next one that we are going to look at is now the types of share capital. Okay, the types of share capital. So by now, most of you would have, because you have done your GCSE, and you would have seen, you have heard the word authorized share capital, you have heard the word issued share capital, and there will be, called up share capital, there will be uh, uncalled capital, isn't it? So many things are there. So we'll now look at these things because this is what's needed for the start of our lesson. What is authorized share capital? So when a company is incorporated, the authorized share capital will be the maximum amount of share capital. Okay, the authorized share capital is the maximum amount of share capital that a company is authorized to issue. It's the maximum. It's the maximum. They cannot go beyond that. Okay, maximum amount of share capital authorized to issue. Right. So, for example, if the company has been given the authority to issue 500,000 ordinary shares of £1 each, that is their authorized share capital. So, the authorized share capital is the maximum amount of share capital that they are authorized to issue. Okay, that's the authorized share capital. From this authorized share capital comes the issued share capital. It's the issued share capital. So from the authorized share capital, the issued share capital will be the amount of share capital actually issued. Maximum amount of share capital authorized to issue is the authorized share capital. The issued share capital is the amount of share capital actually issued. The amount of share capital actually issued. So from that 500,000 ordinary shares, I said, let's assume that the authorized share capital was 500,000 ordinary shares of £1 each. Out of that, if the company has issued 300,000 ordinary shares of £1 each, then the issued share capital is the 300,000 ordinary shares of £1 each. Is it clear? Right. Authorized share capital understood, maximum amount of share capital authorized to issue. Issued share capital is the amount of share capital actually issued. Okay. The next one that I have to explain to you is the called up share capital. Before that, I'll give you a small introduction about how this thing is uh, broken down. Okay, right. Now, when a company issues shares, what is a share? A share is a small unit of capital. A small unit of capital. It has to have a value, isn't it? So it has to have a value. It has to have a face value, or we call it a nominal value, right? So let's assume that, as I said, the authorized share capital has been mentioned as 500,000 ordinary shares of £1 each. £1 each. Therefore, then this pound one is the nominal value of the share. This £1 is the nominal value of the share. Okay, or it's the face value of the share. Okay. Now, do you think a company will need this £1 in one go? No. The company will not need this £1 to be collected at once. Okay. Based on the necessity, based on the requirement, how the company has planned to acquire the finance, they will break this down into different stages. This nominal value may be broken down into different stages. Okay. There can be, or there should be, an application stage. There should be an allotment stage, and there should be a call stage. Okay, there should be a call stage. Is it clear? So the £1 nominal value has been broken down into applications. Let's imagine it's going to be 0.50. Allotment stage, is assume that it's going to be 0.30, and the call stage is going to be 0.20. So the £1, 0.5, 0.3, 0.2. That makes up the £1. The issue price is £1, right? Now, the called up share capital will be, let's assume that at the time of speaking, the company has called up the shares up to this stage. That's 0.80. That's the application 0.5 and the allotment 0.3. Therefore, the called up share capital will be, my loving students, the amount of share capital shareholders are required to pay. So let's assume that it was 0.8 for our explanation out of the £1. If 0.8 has been, the shareholders have been required to pay, that is your called up share capital. That's your called up share capital. Of course, if 0.8 is the called up share capital, 0.2 will be the uncalled share capital, because out of the £1 they have called up only 80 pence, so 0.80, that is the called up share capital, and the 0.2 which is on the call is still the uncalled share capital. Is it clear? Is it clear? Right. So we saw how a capital structure is made up of. We saw the types of share capital, right? The authorized, issued, as well as the called up share capital. And we saw in the called up share capital how it can be called up and how can there be an uncalled up capital in the nominal value of a share. Is it clear? Right. We'll move on to our next area for explanation, which is going to be the most important part out of the capital structure, where you will have to really understand this thing to get a very good understanding of how to follow things further. The capital reserves and the revenue reserves. The capital reserves and the revenue reserves. Now the word capital itself describes to you that it's a legal requirement, isn't it? It's a legal requirement. So the capital reserves are created with the provisions of the Companies Act. Okay, the capital reserves are created according to the provisions of the Companies Act. Okay, therefore, it is not on a voluntary basis, on a compulsory basis. Okay, so capital reserves are reserves created from the statutory requirements that are there based on the Companies Act. Okay. Now, what are the capital reserves that we are going to look at? What are the capital reserves we are going to look at? For your unit requirement or for your syllabus requirement, we are going to look at the share premium. We are going to look at the share premium. We are going to look at the revenue, the revaluation reserve. We are going to look at the capital redemption reserve. So we are going to look at the share premium, we are going to look at the revaluation reserve, and we are going to look at the capital redemption reserve. So we need to know for the syllabus how is this created and what it is utilized for and the general meaning of the reserve. Okay. So you understood that the capital reserves are created based on the provisions of the Companies Act. It has got a statutory requirement and it is made up of the capital profits. Okay. There are capital profits, there are revenue profits. So capital reserves are made up of the capital profits. Now let's have a look at the three reserves I mentioned. Now remember, one key difference between the capital reserves and the revenue reserves will be that you cannot utilize the capital reserves for the distribution of dividends. Okay, you cannot utilize the capital reserves for the distribution of the dividends. Let's see how this and why it is like that later. Capital reserves, I'm going to mention the three capital reserves, not you. The first one is a share premium reserve, the share premium account or the share premium reserve. Right. Now I can start from here itself, as you can see very clearly, that if a company has a nominal value of £1 each, if a company has got a nominal value of £1 each, let's assume a situation that if a company's nominal value of a share was £1, but the issue price was £1.5, then you see there's a difference here of 0.50, and that is your share premium. So when a company's shares are valuable, or when it is valued at more than the nominal value, the issue price is greater than the nominal value, there comes a share premium. Is it clear? Right. Remember, the share premium is a capital reserve. You cannot utilize it for the distribution of dividends. You cannot utilize the distribution of dividends. Right. Now, what can you use it for then? What can you use it for? It's very important to see, because the examiner wants you to know what is the reserve, How is it created? Which is a double entry, which I'll come in my next lesson. And what is it utilized for? Remember, the first thing that we can utilize the share premium is to issue bonus shares. Don't worry about bonus shares. Don't worry about rights shares. Don't worry of redemption shares. I will cover later. You can utilize the share premium to issue bonus shares. Okay, you can use it to issue bonus shares. Second one is you can use it to write off any preliminary expenses that were there in the company. Okay, to write off any preliminary expenses. Okay, to write off any preliminary expenses. Third, you can use it to when shares are redeemed, or when a company buys back shares, if there was any premium involved in that process, you can utilize your share premium account to pay off that premium that was there on the redemption. Okay, which will also be looked at later. You can also look at any discounts, or any writing off, or any discounts that you had to be given on the debentures, so and so. You can use the premium for that as well. Is it clear? How is the share premium created? When the issue price of a share is greater than the nominal value of a share. What is it utilized for? You can issue bonus shares from it. You can use it to pay off the preliminary expenses. Can be used to pay for the redemption, for the premium on the redemption of shares. And if there was any discounts or whatever called on the debentures, it can be used for that as well. Clear? Important thing: cannot use the share premium for any dividend payouts. Is it clear? Right, good. Second reserve we are going to look at is your revaluation reserve. The revaluation reserve is created when a company's non-current assets are revalued. Okay, when the company's non-current assets are revalued, then we create a revaluation reserve. Okay, we create a revaluation reserve. Remember, the revaluation reserve can only be utilized for a bonus issue of shares. Okay, you can utilize it for a bonus issue of shares. So it is created when a company's non-current assets are valued greater than its, when it is revalued, when there's a capital gain on it. Okay, so when the non-current assets are revalued, if there is a gain on it, you cannot utilize that for a bonus issue of shares. Okay, so that's another important thing that you have to understand in the. You can utilize it only for a bonus issue of shares. Sorry, you can only utilize it for a bonus issue of shares. Okay, right. The third reserve that we are going to look at is the capital redemption reserve, or we call the CRR. Okay, it's going to be a separate area to be covered. The capital redemption reserve. Okay, what is redemption? So redemption is buying back. When a company has issued redeemable preference shares, you have to buy these shares back from the shareholder. So when they buy these shares back, the Companies Act has prescribed, the Companies Act has mentioned that in order to maintain the capital base, or we say in order to protect, in the old version we say to protect the creditors, right? We have to create a capital redemption reserve. This is a separate area that I will be covering. So we'll see how the capital redemption reserve is going to be created. Importantly, what we have to keep in mind is that the capital redemption reserve can only be used for a bonus issue of shares. Okay, you have to use it for a bonus issue of shares. Capital reserves done, created on the company's based on the Companies Act, statutory requirements. Main area that we saw in the three reserves I spoke of is that you cannot utilize it for the declaration or payout of dividends. Okay, share premium. We saw what the share premium is, how it is utilized for. We saw the revaluation reserve, and also we saw the capital redemption reserve. Right. Now the revenue reserves. It's very important to understand the last part of my lesson today, the revenue reserves. Now revenue reserves are of course created from the revenue profits. Okay. So revenue reserves are voluntary, it's not compulsory, created from the revenue profits of a company. The word itself then indicates that if it is revenue profits, remember you should be able to utilize it. You should be able to utilize it for dividends payout. Okay, you should be able to utilize it for the dividends declaration. Okay, the revenue reserves. What type of revenue reserves are we going to look at? We are going to look at two types of revenue reserves. One is, of course, the retained earnings. Okay, the retained earnings and the general reserve. So the simplest of explanation is that the revenue reserves have been created from your revenue profits. Okay, it is voluntarily, and you can utilize it. You can utilize it for your dividend payouts or for the dividend declarations compared with the capital reserves. So today we have looked at the capital structure, we have looked at the types of shares, and we have looked at the capital reserves and the general and the revenue reserves that is needed for your for the next stage of your lessons. So my next lesson that I'm going to look at is going to be the IPO, because that's going to take a little bit of a time. The IPO process, the application and allotment stage of the issue of shares. Okay, right. So please follow the channel and share it with your friends, and make sure that you get everything that has been mentioned to be given, because it's free of charge for you. And I wish that the knowledge that you gain from this will be helping you for your future accounting prospects that you are having. Thank you very much. I'll be catching you soon with the next content creation, which is going to be the IPO, the initial public offering of shares. Thank you very much. Have a wonderful day.